How is it that about 90% of investors lose money in the stock market? And no, that doesn't just include the average Joe on Robinhood that's YOLOing money on stocks and options for the very first time. In fact, buy a common index fund and you outperform virtually everybody else by default. Even hedge funds, people who do this stuff for a living, literally paid to outperform the market. Take the average hedge fund, they haven't done so in the last decade. And then us, the average investor, well, we kind of suck. So why is it that almost all of us stink at investing, including most of the professionals? Sure, we could blame unexpected downturns in the market, like the 2008 Great Financial Crisis, or the COVID shutdown, or emotional trading, or how it's a big money game and it's rigged against us. There are plenty of excuses out there, but we can dive deeper than this, and once you see the truth, you'll never unsee it again. The question to answer is, why do we sell at bottoms and buy near tops? And you know, I'll share my embarrassing moments first. I panicked and sold Nvidia and Tesla at the bottom of the pandemic. I literally sold them in February and March of 2020. And you know what? I don't even want to look at what those positions would be worth now because it's borderline shameful. And actually, now that I look a little bit more, I don't know what the hell I was doing. It's probably in my day trading phase and trying to make $5 to $10 a profit a day, I guess. Whatever. And this year I've been averaging down on end phase and, well, I'm sure you can imagine how that's going. Enough about me and my trades. I want to use these examples as emotional trading mistakes and how it can be detrimental to our future success. The stock market is a vehicle of human psychology driven by the means of greed and fear. All those little candlesticks that you see on a stock chart, each of those little snippets of time, whether you view them in minutes, hours, days, weeks, they all represent market sentiment. How people are feeling about their investments during that period of time. That may be true for a small period of time, but eventually all stocks must return to their fundamentals, right? Surely the stock market has to revert back to its mean, its average. Well, no, it's a little more complicated than that. The efficient market hypothesis is an investment theory that teaches students it is impossible to beat the market because the stock market is perfectly efficient. In other words, don't even bother trying to outperform the market because stocks always trade at their fair value. And let me tell you, the most successful investors on the planet don't tend to agree with this theory, and nor does historical data. Buffett in particular has publicly thanked the professors and institutions teaching this concept as competing against opponents who have been taught that thinking is a waste of energy. And let me ask you, what do you think? Do you think AMC and GameStop were fairly valued during the epic short squeeze of January 2021? Do you think Nikola, FTX, or Enron, any of these historic fraud cases were fairly valued? I think you can go through countless examples in history of stocks that were certainly not fairly valued at one point or another. And this is what we should expect because the stock market isn't based on just the fundamentals and the data, it's based on emotion. Sure, all things will eventually revert back to its mean, and that's exactly what the market does over time. But emotion is what drives these crazy overvaluations and these very steep sell-offs. Every single time the S&P 500 deviates from its average PE ratio, it finds a way back to the mean. And like we mentioned, whether that be tanking during recession or jumping during an opportune time, it doesn't matter. I feel we can definitively say the market is not 100% efficient. Also, if this were the case, then there would be a 0% chance of outperformance. And although most people lose, there are funds and investors out there that do outperform. And so that brings us to the first aspect of defeating the emotional market, and that's understanding base trading theory. The idea that the market is simply a vehicle of emotion. So, what's the solution? Drive it devoid of emotion. Shut out the noise, shut out the news and social media. Focus in on building your system and create a way of using data, logic, and the facts to drive your decision making. We all know it, but we still continue to do it. We got to go deeper. Picture this, during World War II, the United States used bomber planes as their primary means of ground support. Some bomber planes returned to base from their mission, others didn't and were shot down in combat. Those that did return to base were studied and inspected for damage so Americans could identify what parts of the plane needed greater reinforcement. Now, how the hell does this relate to buying when things are high and selling when things are low? Well, that's survivorship bias. An engineer realized that the worst hit planes never came back. The spots showing little to no damage on the surviving planes were actually the worst parts to be hit. Planes that were hit in these spots never returned, yet researchers only focused on the planes that survived, the planes that successfully returned from their mission. In the stock market, we tend to focus on what has been successful in the past. It seems easy, right? Just pick all the stocks that everybody else has done well with. If they've been successful, then surely I will be too. Look around the world of social media. You'll see everybody is winning. People are booking profits left and right. TikTok gurus are making millions and buying Lamborghinis, yet the numbers are telling us the exact opposite. This is survivorship bias at its finest and is really the foundation behind the well-known saying, past success is not indicative of future results. Just because something worked in the past, the planes that flew off and returned from combat doesn't keep us from looking in other spots. The spots that are most lethal to the plane, the parts of the economy that are most potent for our future returns. And so this brings up the question, how does success, the thing that we strive to achieve every single day in all facets of our life, actually become dangerous to our future? Let's start simple. The market operates in waves, in cycles. It's not a straight line up, although it may appear like that over the long term. To play the different market cycles without falling into our old ways of thinking and sticking with the ways that have brought us success in the past, to not fall victim to complacency and ignorance, all it takes is a little reevaluation. Sure, you could have bought the biggest and most successful tech companies in the world, Microsoft, Google, Apple, Amazon, become a millionaire and never thought about it again. Yes, that may be true, but for every one Microsoft, Google, Apple, or Amazon, there are thousands of others that have failed. We never see the full story, we only see the successes. And for perspective, 0.0000015% of businesses ever reached the level that those tech giants did. Oh, and 90% of startups fail. It's nearly guaranteed failure, yet we look online and think everything is sunshine and butterflies. And because of the incredible odds stacked against business success, I'm a big proponent of investing in the companies that are the most well-positioned in the fastest growing sectors. Who is the most profitable? Who has the best business model in the sectors that are making the most money? All it takes is some due diligence and then just put through automatic buy orders every day, week, month, whatever cadence you want. That way you aren't susceptible to emotion, complacency, or just the overall fluctuations of the market. Don't be sad on red days and happy on green days. Just buy at every point, and over time, when those sectors do bounce back during their market cycle, you'll be there first in line to reap the reward. I go through these sectors and companies that are primed for success in my last video. I base all of my videos purely on data and mathematics. Buffett says risk comes from not knowing what you are doing. If you are investing in companies that are fundamentally valuable, have a competitive moat, positively impact society, and companies that you actually understand, there is no risk. Sure, there could be fraud, information you don't have, or shocks that you couldn't anticipate. But these things are all out of your control. Control the things you can control, and the point is, reduce the risk to as close to zero as it can possibly go. There will always be times when you fail and others where you succeed, but it always seems to be so hard to bounce back after a market loss. It's far easier to relieve ourselves of the pain, to stop the bleeding and just sell our positions off when we should be buying. We just feel so good seeing our positions in the green. So buying at the tops of hype cycles, it's easy, because you get that immediate gratification, that immediate realization of success, an immediate sign that, hey, we might actually be pretty good at this whole investing thing. Meanwhile, all the big dogs are booking their profits, selling their positions over to us during the tops of these hype cycles, simply just waiting to take advantage of the next market cycle. It all comes down to the dangerous psychological concept of instant gratification. Of course, this isn't a psychology lesson, but it's critical to understand why we do what we do with our money, so we can prevent and change that thinking in the future. Instant gratification is exactly what it sounds like. As humans, our brains are biologically wired to enjoy things that are easier, that put our mind at peace. Enjoy the things that benefit us right now in the near term, to put aside our long-term goals, aspirations, our vision of what we want our life to look like in the future. Delaying gratification is the key to investing. Is it difficult to hold on to a position that day after day you just watch your net worth trickle lower and lower? Of course it is, so we try to avoid it. Is it easier to ride the hype wave and buy a meme stock that's jumping 10, 20, maybe 50% per day? Everybody and their grandmother is booking profits and showcasing it all over social media. Well, of course it's easier. It's easier, so we want to do it. It's more pleasurable for our brain, and therefore we do the same thing again and again and achieve the same result. We mull around in our thoughts for a few days, questioning why we even started investing in the first place, questioning the whole vision that we started with to build wealth over the long term. Instead, we worry about the little things like market fluctuations on a daily basis and let that impact the logical steps of making our vision a reality. We always want to be instantly gratified for our actions, our stocks to be up the next day after we buy them, or immediate success in all facets of our life. But it takes delaying this gratification to achieve that vision of long-term wealth. In the end, do you really think it matters if we buy a stock today, tomorrow, next week, next month? Probably not. But our brains are programmed, are wired in a way that makes us think if we don't have success today, then what makes us think we'll be successful in the future? So now we understand why we think the way we think and do the things we do. And the best part is we can actually measure these things with numbers. Complacency, fear, greed, all this emotion may seem abstract at first, but there are indicators out there that represent the sentiment of the market. While you as an intelligent individual are riding the waves of the market using a systematic approach, an approach based purely on mathematics and data, others are out there emotionally trading, selling at the bottoms and buying at the tops. And when everybody else is yelling buy, that's when you look at these indicators. When everybody else is calling to sell everything and the next great recession is coming, this time is different, that's when you look to math to help. The Fear and Greed Index attempts to quantify the market sentiment by using financial indicators, real data. And as you could imagine, measuring emotion isn't just some one-size-fits-all approach, but this one has certainly done a pretty good job of showing you when people are becoming a little too emotional. When fear is high, great rallies typically follow, and vice versa. Are you starting to see how this market is driven almost purely by emotion? Using measurable financial indicators like market momentum, stock price strength and breadth, put-to-call ratio, and a bunch of other complicated derivative markets, we can create a fairly accurate gauge of how the market is feeling as a whole. Another one that may be less obvious at first but makes sense logically is Google Trends. Have you noticed that the second everybody starts talking about something, it seems to go the exact opposite way? The second everybody is confident in Bitcoin going to 100K right when it breaches 70, or everybody is selling out of the market because COVID will ruin the economy forever. Look at this. Google search trends of the term market crash spikes significantly during just that, a market crash. However, in each case when the search term is at its highest point, it seems to line up almost exactly with the bottom in the market. Coincidence? I think not. The second you are willing to give in and stop the pain, stop the bleeding, that's when the emotionless traders swoop in, scoop up their shares in the shadows. People may call them stupid or dumb to think that this was an opportunity or this was worth the risk, but they know what they are doing. And this image always comes to mind when I think about it because it's so ridiculously true. Everybody and their mother is lined up out the door ready to buy Nvidia at $1 trillion valuation, but nobody was calling for a buy when it was at $100 just 1 year ago. Jump on the bandwagon while you can. How about another one, the AAII Bull Survey? You are sent one question. Are you bullish, bearish, or neutral on the stock market in the short term? And if you didn't think the last Greed and Fear Index reflected emotion closely enough, this one is surely undeniable, but just how accurate is it? Well, we have data that goes all the way back to 1987, and you can pause the video now and go through all the scenarios that you'd like, but it's pretty evident that when we get towards 60 to 70% of people feeling good, ready to buy the market, that's just when the market is closest to its correction. And likewise, when we get to that 20% mark and everybody's so sad, it marks one of the most opportunistic times to enter the market. The links to all these resources will be in the description. In the end, the stock market is just a game of psychology. Whether you think you know that a stock has to be undervalued, the financials, the leadership, it's all pointing to a jump in price, or maybe you know that a poopy stock like AMC or GameStop is eventually doomed to fall. It's inevitable. I encourage you to think again. Reevaluate the situation, strip all the emotion, all the heuristics that have trained and wired your brain over your entire lifetime. Take a step back and just look at the data. And when everybody else is falling victim to emotion, riding the hype waves to the top of the market cycle and falling into despair when things go bad, that's when you stick to your strategy. You stick to your plan to achieve that vision of ultimate wealth. And I do want to say that day trading is cool and you can be successful at it. I've had plenty of successes and far more failures in the market, but that short-term vision, that short-term goal of booking profits on a 1-minute chart or 5-minute chart, it was just too taxing on my brain in particular, and I needed that peace of mind, so I just stopped doing it. But in the end, it's only risky if you don't know what you are doing. And so I wish you good luck with your investing and trading, and if this perspective helped just one person out there, that makes me proud. And so with that, I'll see you in the next one. Peace!